Good morning, good morning. Welcome to Marketplace this Wednesday morning. Today we want to have a conversation around protecting your high-value assets and basically just looking at some of the insurance covers that are out there in the market. Again, this is a conversation that has become quite prominent lately following the flooding that we saw in the country. To help me with this conversation, I'm joined in studio by Latif Wekesa, who's the Head of Business Development at Minet Kenya, as well as Michael Omondi from CPF, and also Laser Insurance Broker. And gentlemen, thank you so much for making time to be with us this morning. And I want to start with you, Michael. So the first thing that comes to mind is whenever you're looking at an insurance cover to take, what are some of the key considerations that our listeners need to look out for?
Thank you, Jimmy. One of the things that our listeners need to be keen about is the risks that they want us to take on board, because insurance is all about risk management. Now, from a broker perspective, getting to know the risk that the insured wants us to take on board is very important, because with that in mind then, from a technical point of view, I'm able to come up with the direct solution that he requires to put in place to cover that important asset that he or she have. So getting to understand the particular risk is very important, and that is perhaps the asset that the insured wants us to take on board. So it begins at that point of clearly understanding what is it that the insured wants us to take care of, and with that in mind then we employ our technical skills to be able to come up with a direct solution to take care of those risks. All right,
so and Latif, just looking at the assessment of this risk, there's the question of the value. How then do I know, for you as an underwriter, what are some of the key considerations that you look at to know that we're going to price this risk at this much?
Oh, thank you. And thank you, Jimmy, for having us. And it's a pleasure to our listeners to get to know more about insurance. So I think the critical component when it comes to what amount of value do you need to insure also begs the question, how much do you stand to lose in an event of a loss? So a basic example is motor vehicle, and insurance operate on what we call insurable interest, meaning that whatever you're supposed to insure should be equivalent to the amount of loss that you're supposed to have. You're not supposed to benefit from an insured event. For motor vehicle, ordinarily you'll have the actual price that you actually bought your motor vehicle. If, for example, you've taken 3 or 4 years, and maybe because of market inflation, remember there are new legislation changes that looking at Finance 2023, where the import duty went to 35%. Yeah. So those are the factors that you look across. So we rely a lot on experts in terms of who understand machinery valuation or motor valuation to come up with a specific amount that will, in the event of the loss, you'll be able to be taken back to the position that you were. So if it's motor vehicle, we rely more on motor assessors. If it is a building, then we have the quantity surveyors who are able to actually to advise how much it will cost to replace. I think the most critical bit that a listener or any consumer of insurance should take into account is, if you take up an insurance, you are buying peace of mind. And in addition to peace of mind, you need to be reinstated back to a position prior to the loss. Yeah. So having a knowledge of what it will cost you to buy a similar product is a step for you achieving the correct amount of what you need to insure.
All right, so Michael, again, when you speak to a lot of your customers, I'm sure premiums determination is an important aspect of that conversation. Mm-hmm. So in as far as payment of premiums goes, what are some of the offers that are currently in the market that then would help bring more Kenyans within that insurance bracket, increase insurance penetration, and at the same time, because again, their biggest concern, and something that we have seen over the last couple of years, is the fact that disposable income is fast diminishing.
Thank you, Jimmy. Yeah, that's true. We have experienced that a lot of clients are struggling with premium payments, and as you've rightly noted, the disposable income is coming low. So, and again, you know, also the Act actually says that insurance policy should begin when premium is paid. So striking a balance in between the dwindling incomes, the need for cover, the need to pay for premium upfront is a balance we have somehow have to manage. So what you are doing, depending again, because you have corporate clients and you have individual clients and you have SMEs, all of them have different levels of premium. For individual clients, the cash and carry is easy to manage because the premiums are not that voluminous. But when you're talking about a large commercial client with big volumes of premium, it may not be easy for them to pay you upfront because they have their other business needs that still require finances. So to help them manage, some of the options we have is that we can go into an agreement where we have a staggered premium payment, a credit facility agreed between us and the underwriter. Maybe 2, 3, or 4 installments, depending on the volumes of the premium. Again, we look at the client history. How long has this client been with us, and what is their premium paying history? So with that in mind, again, it's easier to negotiate for staggered premium payments, so that at the end of the day, we assist the client to be able to still meet their obligations under premium payment. Of course, lately, premium management is a very key component of our business because the new regulations of regulatory, the IFRS 2017 has come with its own challenges in terms of revenue recognition, both for us and also for the underwriter. So that still remains a very important aspect of the business that we actually need to and must be alive to, that premium also must be paid within a given time span. But by and large is that we have to listen to the client and strike a balance in between, helping them to manage to pay their premium and to get the adequate cover, and also to ensure that when the unfortunate event happens, then the insurance company has resources enough to be able to settle their claims.
All right, so Latif, I want you to help us understand, in terms of the categorization of some of these different asset classes, what are some of, even just talking about something like value, what are some of the key considerations for us to say then that this is a high value asset?
Thank you, Jimmy. And I just wanted maybe to add a word or two in terms of managing the premium. Of course, there is insurance premium financing that banks are actually supporting. And more importantly, us being in the insurance space, in insurance broking, where our role is actually advocacy, we have developed product where you have a tailor-made short-term cover that can actually have a spread up to 12 months that will enable client actually to meet their needs. So when it comes to categorization of policy and just look at what is this that it could be high valued and how do you categorize them. For example, we have precious items like the jewelries, where on face value, when you look at it in terms of holding it, you might think that it could not carry a lot of value. But if you go to an expert and you get an evaluation of it, you realize that just a mere ring could cost over to more than 2 million, 3 billion shillings. So it's important for a client, of course, to have the awareness. So where we sit, we look at, one, the portability in terms of the item, the disposability in terms of the market. How are you able to liquidate such a product? Then it can define whether it's high valued or not. Ordinarily, from a corporate perspective, definitely you'll have major companies handling quite a big of machinery, which are quite substantive, they have already been valued, then you can be able to define. And I mean, one of the questions which maybe I'll preempt is, how do you categorize? What do you look into? What covers will make sense?
Exactly.
So more importantly, in insurance, we have two models of cover. There's what we call a named peril policy and a named peril policy. Peril, in a layman, is what leads to actually a loss. So if an event occurs, maybe because of a theft, you lose your item, that is actually a peril. So in that, having that awareness, then you look at whatever I hold, is it a portable item? Can it be moved? Is it stationary? For example, a building ordinarily is not portable. It's a stationary item. Then the threat to a building ordinarily will be fire. So there are insurance policies from fire, burglary, all risk, which have been tailor-made to respond to particular peril, depending on how the asset exposure is faced. So for the building, for example, the threat to a building ordinarily will be like what you have seen, the floods. So meaning that if it is not stationary, it will actually be met at that point. We have fire, which will only attack a building, but issues to do with the laptop, your mobile phones, they are portable. They can easily be stolen from any particular area. So one of the things as a listener, when you think about purchasing insurance and just identifying the correct cover, because one of the challenges in what we have is if you don't pick up the correct cover, then you will not be buying insurance. In an event of the claim, then you will be told, oh, sorry, this was not covered, yet you didn't get the correct explanation. So having in mind in terms of the nature of item, the portability, what is the threat to it, then defines the appropriate policy that will actually be put in place. And what I'll urge our listeners is we have quite a number of insurance professionals that are available here outside here, and most of us, we are willing to help and just provide guidance what you require to purchase an insurance. So there's quite a range of products. So if I can just cut it, so you'll have property, and in general insurance you look at property and you look at liability. Property is anything that relates to an asset. So be it building, be it laptops, machinery, those ones will fall under property insurance. But in insurance, we have what we call more specific insurance, and that's why I talk about the exposure that is a threat. Then we have liabilities, and some of them takes up upon statutory policies like the WIBA. We have Occupiers Act, which requires you to have a public liability policy. We have a product for those ones who are in SME and in business of manufacturing. Yeah. We have quite a range of product that we'll be willing to guide our listeners to be able to pick up the correct solution.
All right, and Michael, of course, when you look at something like home ownership, that is quite an expensive undertaking. So in as far as insurance goes, what are some of these options? Because again, when you look at car insurance, for instance, you have third party and you have comprehensive. What are some of the possible options that are currently available in the market for home ownership?
For home ownership, the most taken cover is actually a fire policy, which we call fire domestic or homeowners insurance. Because looking at the risk, basically, is a low risk because this is a house for a dwelling house, yeah, where you live with your family. So basically, your first interest is to protect the cost of reconstruction. Should that house come down, either it's burnt by fire or is damaged by whatever cause. So then the first thing you need to protect is the cost of reconstruction or the market value of that particular house. Then you have your own contents in there. So what we normally give the fire domestic package is a very broad insurance cover because it is in different sections. As I've said, Section A will cover the buildings, Section B will cover the contents. This is where you have your furniture, you have your kitchen equipment, you have your bedrooms, the beds, the clothing and all that. Section C will cover all risks. And this is where you have electronic equipment in the house. Things like the television sets, you have computers, you have laptops, cameras, and things like that will be covered under Section C of that particular policy. Then Section D will cover your domestic servants, you know, your shamba boy or your house help, all the people you employ to assist you with maintaining the home, who are your direct employees, because then they have an employee-employer relationship. You pay them. So the WIBA Act that my colleague Latif talked about requires that all employees must be compensated for work-related injuries or illnesses. So you have a duty and an obligation as an employer to bring up an insurance policy to cover them, because we've also seen claims coming from domestic servants. Like one time we had one where a house girl got burnt. The gas exploded when she was in the house and she got burnt in very bad injuries. So Section D will be sensitive to that. Depending on the number, we are able to bring them in. And then Section E will cover, Section E and F will both cover liability, either as an owner or an occupier. If you own the house, then we'll give you owner's liability. If you are renting, then you are an occupier, we'll give you the occupier's liability. Basically, this takes care of the legal liability you owe to the people who visit your home.
All right, and So, Michael, just looking at the two different options, in terms of premium payment, how much are we looking at and at what interest are they charged?
It is not a straight rate that is applied across every section. Like the section A for buildings has its own rate, and when it comes to buildings, we classify that risk depending on certain underwriting considerations.
Yeah.
Of course, we normally take first class buildings, either constructed of stones, bricks, or blocks. You know, again, depending on the location where it is. When we do underwriting, which is the risk assessment process, and that is the process when we come up with the premium that you are meant to pay, we are able to levy a rate depending on good qualities of that risk, and we also take care of other qualities of the risk that we feel might aggravate the risk. So different sections have different premiums. Like what I'll charge you on Section A will be a little different with Section B and Section C. Of course, Section C, you have portable electronic equipment, so that rate will ideally be different. But by and large, our listeners need to know that home insurance is one of, I would say, easier to get. The premiums are not as high as commercial risk, because when you look at the risk is not that very high, so it's affordable, and we have different options. Again, we have a product where we target people who are just starting life. Someone perhaps living in a studio or in a one-bedroom apartment. They don't have so much. It's different with perhaps a family person who is established and living in a home. So we have all those packages for our insureds and the general public to choose from. But of course, sitting from this point as brokers, ours is to represent the interest of the client. So we know that this person may not have a lot of knowledge. So sitting with you to understand what you require then will help us to direct you towards the best coverage for the property that you want us to help you get insurance for, but the premiums are affordable.
All right, so Latif, again, previously, and this is something that we saw about 3 or 4 years ago, where insurance companies said, we're not going to insure Subarus, we're not going to insure Proboxes because of this and this reason. So when it comes to high-end value properties and assets, are there limitations to what insurance companies can underwrite? And also, what are some of the key considerations to say, maybe this property is too expensive, it is beyond our capacity? Do we have scenarios like that?
Thank you. I think it's interesting. It also took us by surprise as market leaders, but the only good thing about insurance is the ability of customer to choose from a wide panel. So it's not that all the entire industry did decline to take up the Subaru, but it was just particularly what we call risk appetite on particular insurance company. So when you look at insurance, how insurance operates, maybe so that I can build up to answer the correct question, is we have 3 key main players of the insurance. So we have the public, who are the consumer, we have the intermediaries, then we have the insurance company. So insurance company do not have the muscle to insure all whatever they can pick. They need another buffer. So we have reinsurance company who sits behind the insurance company. So at only one particular point where you will find maybe a less appetite is where the risk exposure is imminent or has already occurred or it's beyond. For example, you look at a risk from a war-related, what we call fundamental risk, not particular, because insurance deals with particular risk, fundamental risk, which are general. So insurance company will tend to avoid. But then number 2, sometimes you look at the composition or the nature of the exposure. If it's so imminent or the threat is so huge that an insurance company will look at in terms of admissibility, then they will tend to shy away. Right. But where we sit, there is no risk that cannot be able to be picked. The only thing sometimes what comes in is, remember, there are issues of ESG, where now it influences how insurance company will operate. For example, most insurance company are shying away from coal. It's not that there is no capacity, but there's a duty of coal to actually protect the environment. So with the buffer of reinsurance company, there is no product that cannot be actually be picked unless the definition or the exposure that faces is not an insurable risk. That is where insurance company will not be able to pick such in such scenarios.
All right, and Latif, so that I also get your closing remarks. Can you take us through why does it take insurance companies such a long time to pay up claims?
We as brokers, and my colleague will also tell you, one of the low moments of being a broker is when you're not able to deliver a claim payout. That is one of the low moments in anyone's career. But in most cases, I think there is less adoption of technology. So there is more reliance on human capital rather than adoption of technology, which could actually enable us to verify. Like, for example, I'm sure you have a motor insurance. The insurance company has your details. But when you go to complete a claim form, they still ask you, who are you? What is your name? Still making the process much longer rather than just depending on technology, just provide information under circumstances of what happened to lead to the loss so that they can measure and do the accessibility, whether it's something that is admissible within the policy or not. So one of the things that we also have is also the moral aspect. The reports from IRA shows that 38% of the claims that were registered in 2013 were actually fraudulent claims. So at any particular point, the aspect of moral has influenced a lot of claims. So you'll find that where the insurance company sits, they need also a critical assessment of the claim just to validate, because now the historical performance shows that most of actually the claims that are being filed are fraudulent and leads to claim leakage. Remember, one of the things about insurance is a few among the many who are coming together, where the few will get a loss, and from the many premiums that will be collected, compensation will be done. Yeah. So if a claim that is not valid hits the fund and it's a fraudulent claim, then there's a threat to distinguish the fund such that most people will not benefit. But one of the things that we are changing from the broker perspective, just to ensure that the strict timeline in terms of compensation is going up with what we call service level agreement. We're able to put to task the insurance company to ensure that if you pick up this claim, this risk within 10 or 5 working days in an event of a loss, that will actually be settled. Then we're encouraging a lot of automation, and we are seeing how do we integrate. For example, we have a data from NTSA. All accidents are actually reported within the NTSA. How can they leverage from that information so that they can validate the claim rather than going back to investigate, take another 30 days. So the moral hazard perspective has taken a leg back. Then the nature of the operation, lack of adoption of technology has also taken a leg back. Then there's what sometimes we call attitude. There are just some insurance company who have a low attitude towards settlement of claim. And now that's the advocacy role and the value addition as brokers that we bring on board. We will only direct you to an insurance company that we are certain their record of paying claim is timely, and they'll also adhere to the service level agreement that are actually in place.
All right, thank you, Latif. So Michael, just to close this conversation for us, I want you to help us understand a couple of things. Number one, what percentage of the value of my high-end asset class should I be paying in insurance premiums? Again, for motor vehicle, we know it's 4 to 5%, the value of the car. When it comes to high-end asset classes, such as houses, what percentage is that? And also, can we have, are there options for consumers to pay in a staggered manner? For instance, you can pay annually, or you can maybe pay after every 3 or 4 months or 6 months or 9 months, depending on the agreement that you have with the insurance.
Thank you, Jimmy. Please allow me to add my voice a little on the issue of why claims take too long.
Yeah.
It is, as my colleague said, really, it's not that every claim stays too long. My experience is that every claim is unique in its own way, depending on the asset class and the circumstances around the loss and the documentation required to be able to adjust a loss. So talk about motor vehicle insurance. If a motor vehicle insurance is taking longer, perhaps the investigation bit of it. But if it is a direct claim where you've been hit, assessment, garage, repair, you're gone. Or assessment, write-off, then the sum insured is paid, and the end of story. But when you find a claim taking longer, perhaps injury claims might take longer, because if you're injured today, you will not be paid tomorrow. An injury claim requires you to have gone through medication to the extent of you are almost done, and if it's a disability, you will now live with it. So you might end up going to the hospital for some time before we get the final medical reports to be able to guide us on what quantum we need to talk about. But every claim is unique in its own way, the circumstances, the documentation, and the entire process. And again, as he said, the SLAs, when we sign them, we have time around times. Those TATs are now very key, even for us. Like where I see it from LIB, we normally evaluate performance of insurance companies based on claims payment annually. And we strike off from the list of our pre-qualified insurance companies every year. If you take too long to pay a claim that is direct, then you are not a good suitor for us. We'll just put you aside and ask you to improve on your TATs before we can review and bring you back. So I think from where we sit as brokers, it is key for us to ensure that your claim is paid at the right time, and that is one of the key considerations in partnering with an underwriter, as he said. Why would I be able to give XY insurance company and not XY insurance company? Okay. So I think we need our general public to understand that not really every claim takes too long. It depends on the circumstances, but you have the services of a good and competent broker, then it even moves faster. Now, coming back to the question you asked about rating of high net worth valued items, I would be hesitant to quote a rate because different asset classes have different ratings, you know. But say for a house, a dwelling house, you could have a house worth 100 million. And someone else has a house worth 10 million, you know. And as I said before, there are what we call underwriting considerations. So we look at the environment. This house is used for what? Who are your neighbors? Maybe you are 100 million house, your next neighbor is a petrol station. Makes the consideration of that risk very high, because what happens if there is fire at the petrol station? It will quickly spill over to your home. Now, my 10 million house is in a controlled development estate where everybody is in their dwelling house. I would not rate those policies the same. So it is not straightforward like a motor vehicle. For motor vehicle, it's very easy. But for different asset classes, we need to be sensitive to underwriting, because I think that's where, Latif, you'd concur with me, that we are facing a lot of challenge, because today the public wants to take underwriting pen from us, the professionals, where a client comes and asks you, what rate are you giving me?
All right.
You see, what rate I'm giving you depends on the risk I'm taking on board. But as far as premium payment is concerned, yes, as I said before, we are alive to the fact that most of us are struggling with finances. So options available is one, agreeing on a payment plan, which can be 2-3 months, depending on the volumes. As Latif mentioned, there's the IPF, insurance premium financing, where insurance companies are now partnering with banks, so that the bank can be able to pay that premium one-off. Then you, as the insured, you are allowed to pay the bank in 10 installments or 11 or 12 installments. It will make work easy for you. The other bit that we are doing is also to give you short-term cover, which is commensurate with the level of premium that you are able to afford instant. Like for motor vehicles, if you have a premium that can give you 3 months cover, we give you 3 months cover. It ends, you come back. So in that way, we are able to help you also manage your finances. So there are many options for us to be able to assist the clients to manage premium payment.
All right, gentlemen, this conversation can go on and on and on, but unfortunately, that's all the time we have on this show today. And let's do this again next week, same time, same place, right here on Hot 90.